If this report doesn't stop the Fed, then I don't know what will. Hey guys, it's Jonathan here, and we just got the producer price index number for the month of December. And this might finally be the report that makes the Fed finally pivot on their interest rate hikes. So let's get into it. So for starters, some of you are probably wondering, what does PPI even mean? So PPI stands for Producer Price Index, and that tracks the change of cost to producers of goods and services. So pretty much the cost of the business buying a good. A way to think about it is that CPI tracks how much the consumer pays for a certain good or service, whereas the PPI tracks what businesses pay for goods and services on a monthly basis and the fluctuations in those prices. For the report in December, we got a final demand PPI number of negative 0.5% month over month. This was a significant miss to the downside because for the month of November, we had a reading of 0.2%, and for October, we had a reading of 0.4% month over month. It's a sign that inflation on the producer end is not only falling, but is falling fast. When it comes to core PPI numbers, which takes out food, energy, and trade services cost, we had a reading of plus 0.1% month over month, which is still positive, but is a significant decrease from what we got in November at 0.3% month over month. So with PPI, they split final demand PPI numbers into goods and then into services. So on the goods side, we had a negative 1.6% month over month read, and this is the biggest month over month decrease that we've seen since July of 2022. The final demand energy PPI number was negative 7.9% month over month. This was mostly led by the negative 13.4% month over month decline in gasoline prices. I should explain what final demand means. So final demand basically means that as a business, let's say there's a company and they go and they pump crude oil out of the ground. And then that company sells that oil to another company that refines it. And then that company that refined the oil now takes that refined oil, sells it to a gas station. And then that gas station takes that gas and sells it to a consumer. The transaction right before the one that goes to a consumer, that's considered to be the final demand. That means that the product is pretty much finished and ready to go to a consumer. That's what they track when they say they're tracking the final demand inflation numbers. When it comes to the final demand food number, PPI reading, we got a negative 1.2% month over month reading. But on the gain side of things, the core final demand, which strips out energy and food, was actually up 0.2% month over month, which shows that both food and energy was a big driver in the disinflationary reading that we got. But that 0.2% reading that we got was lower than the 0.3% reading that we got in November. So it still is a good sign that things are trending to the downside. When it comes to final demand services PPI numbers, we got a plus 0.1% month over month reading. The Fed is really concentrating on service inflation. So this is of more importance to them. And a major factor that played in the positive reading was the 17.6% jump in margins for fuels and lubricants retailing. After this very strong disinflationary report came out, we did hear from quite a few Fed presidents. We heard from the Dallas Fed president, Lauren Logan, and she stated that it's appropriate to slow rate hikes at the next FOMC meeting, citing that lower hikes allow the Fed to, quote, make the best possible decision, unquote. Every year, the FOMC voting members do change, and this year she is a part of the FOMC, so that is something good to consider. Then we also heard from the Philadelphia Fed chief, Patrick Harker, and he's another voting member this year on the FOMC. He stated that he believes that 25 basis point hikes will be appropriate moving forward, but he did also say that he does believe that rates still need to go above 5%. We heard from the St. Louis Federal Reserve Chief James Bullard, and he stated that pricing pressures remain too high and that the Fed must continue to apply pressure on inflation to get to a 2% target. He also stated that he penciled in a 5.5% federal funds rate in the December dot plot projections for 2023. And he said that he favors front-loading the rate hikes given the fact that he feels like the Fed has to go above 5% no matter what. And he also didn't oppose the idea of possibly a 50 basis point hike at the February FOMC meeting. Now, the good news is that he's not a voting member this year in this year's FOMC, so we probably will not be hearing from him, or at least his words won't have the same kind of impact they had last year. But this is something good to know. But one thing I will give him credit about, that he did acknowledge the downtrend in inflation does give the possibility for a soft landing if we continue to see reports like this. Then we also heard from Cleveland Chief Loretta Mester. She stated that these reports are signs that we're moving in the right direction regarding inflation, but she still suggested that we need to get to at least 5%. And she's also not a voting member this year as well. So again, her words aren't as strongly, they don't have as much of a strong impact as the voting members. Even though we could see that the Fed still seems to believe that we need to get beyond 5% federal funds rate, the market does strongly disagree with the Fed. Right now, the market believes that there's about a 70% chance that we'll get a 25 basis point hike in February. And then there's a 65% chance that the Fed will actually have to pause at the range between 4.75 and 5% at the March FOMC meeting. And this is some of the reasons why we have seen the market move up over the past couple of sessions, with the belief that the Fed will have to stop earlier than they once anticipated. So this delta that we're seeing between what the Fed is saying and what the bond market thinks is going to happen is a bit concerning to your typical investor, because the data shows that that if this trend continues, the Fed will have to U-turn, even though that they say that they won't, and they'll still go above 5%. And it puts investors in a weird spot if they should believe what the market is saying or if they should believe what the Fed is saying. What do I personally think about this whole situation? I think that if, and this is a big if, we continue to see these inflation reports start to trend to the downside at the pace that they have been recently, that the Fed will have to pivot at their March meeting. And that if they continue on to this above 5% path that most of them have suggested, I think that they have a really strong chance of avoiding the possibility of a soft landing and pushing us into a recession. So for me, this is just what I'm personally doing. This isn't financial advice to you. You guys do know I am a licensed financial advisor, but I'm not your licensed financial advisor, and I can't give you personalized financial advice. But for me right now, I think I'm going to use between now and the March FOMC meeting to continuously dollar cost average into stocks that I believe in. And right now, I have a strong belief of companies that have pricing power. So these are companies that have high margins, that I think they can keep up the margins if we were to head into a recession, and that are more on the growth side of the market. I'd like to thank you guys so much for watching. And as always, please like and subscribe and share this video to a friend or someone who you think would be interested. And I'll see you in the next video. Peace.